I'm joined again by my colleague Mary Tate, Senior Investment Director of FIM Capital, to talk about what's going on in investment markets over the course of 2022 to date. And Mary, I think it's fair to say we thought we were in for a bit of a respite in the third quarter of the year after two fairly bloody quarters for not just equity markets, for bond markets, for property markets, for gold, for just about anything you could think of, sterling in particular. And yet here we are at the end of Q3 and things don't look any better. Is there a glimmer of hope out there in the market, or are we set to be looking at another down quarter as the year progresses?
Well, it's a very good question, Russell, and I don't think we fully know the answer to that at this stage. What I would say is that we did get a reasonably positive set of second quarter numbers from the US market, which is the engine of global economic growth. In the second quarter, generally speaking, the earnings surprises were positive. So that drove markets higher in the sort of July-August period. But in September, I think we saw increased issues with inflation overshooting the mark again, higher interest rate expectations, and another general push downwards for high-value stocks. So we saw a sort of resurgence in that, and also fears growing of a recession in the markets, which is what has driven them down another leg at this stage. Although, having said that, I think in July and August we predicted that might happen, that we might see another leg down because of recession fears as opposed to inflation fears. But I think it has knocked sentiment significantly. So I think sentiment generally remains very weak, even if we still see some reasonable returns in the third quarter earnings season for the S&P 500, the US equity market. And the US is very good at predicting what will happen in terms of short-term earnings, but it remains to be seen whether that pans out the way it's expected to. I think in the longer term we are expecting slightly better numbers from CPI, certainly in the US, although I think that's going to be a lot stickier on the inflation side for the UK and Europe over the next 12 to 18 months. Europe in particular is an energy taker rather than an energy maker. So I think we're going to have issues with energy prices and also cost of living increases in Europe, as opposed to the US, where things are looking potentially a little bit rosier. And I think the expectation at the moment for economists certainly is that US interest rates will roll over quicker than they will in Europe.
Right. And I think unusually this year to date, the bear market started right at the beginning of the year, the calendar year. So in terms of investor returns, they look particularly bad. And there's been no period of time during the year yet when really markets have gone up meaningfully. And we talk a lot about the US, and it remains our favourite market. It's a great market in terms of depth and the number of companies, the size of the companies, and just the general market itself. Its GDP growth is typically superior to anywhere else in the G7, particularly now that China is starting to fall away on the growth side of things. But the really interesting news over the last few weeks has been in the UK, has been in politics, and the appointment of Liz Truss as Prime Minister and Kwasi Kwarteng as Chancellor of the Exchequer, and through his mini-budget, chaos on investment markets, particularly on the gilts market and in the currency market as well, where at one point sterling slid so low it was almost at parity with the US dollar, and it's recovered a little bit of its poise since then. So there's two things going on there. We've got problems in the gilts market, one of the world's safest places to put your money, and we've got problems in the currency market with sterling as well. So can you just add a little colour around both of those two very important subjects?
Certainly. I think the colour is a bit dark at the moment, I think, in terms of what's going on in the gilt market, certainly. We already had a struggle for gilts to make any return progress in terms of returns this year, despite being the supposed safe haven asset class. And I think that's primarily due to the fact that we were expecting higher interest rates and higher inflation to begin with, and sterling had already fallen on the back of that, but also on the back of the fact that the dollar is the safe haven currency, number one safe haven currency of the world. So if you look at the dollar versus sterling rate year to date, the dollar has accreted by about 18% over sterling year to date. But against the euro has only appreciated by around 4% against sterling. So this is also very much a dollar story as well as a sterling story. What's happened more recently is that Kwasi Kwarteng's budget release, his mini budget at the end of September, was very, very poorly received by the market because effectively it gave all the bones and none of the flesh. So there wasn't enough detail on how he was planning to fund the tax cuts that he planned, which subsequently has reversed his decision on, which subsequently led to less credulity in the market in terms of the ability of the government to actually take policy forward in a coherent way. And what happened then was we saw the Bank of England coming in and interfering with bond markets because there was an issue with liability-driven investments in the pension market, where effectively they seek to cover holes, if you like, in any liabilities they have for current pensioners looking for drawdown from final salary pension schemes. So they take out interest rate derivative products. And as a result of that, there's quite a little bit of leverage in that market. And as Kwasi Kwarteng announced his budget and the market responded with higher yields on gilts, this forced these pension companies into margin calls, and they had to sell not only gilts but also commercial property and anything else they had that was liquid in their portfolios that was probably generating a high yield as well, because that's what pension funds typically go for. So it's had a knock-on effect across the gilt market and also across the commercial property sector, and I wouldn't be surprised if it's taken out a few infrastructure funds as well in terms of immediate selling. The danger is that we get the Bank of England having to come in and interfere with the bond market and to effectively go through another cycle of QE, when, as you know, Russell, the whole point of bringing inflation down is for the Bank of England to implement QT, quantitative tightening, not quantitative easing. So to have fiscal policy acting in defiance of monetary policy is not an ideal way to take forward an economy. Hence the reason why sterling has remained weak, and the gilt market is down nearly 30% this year, which is absolutely astonishing.
Yeah, absolutely incredible. So there's really been no hiding place at all, has there? I mean, equities are down, the sterling bonds are down, dollar bonds are down as well, dollar equities are down, everywhere you look it's down. And really the only safe haven for your money this year has probably been dollar deposits, really, which are now earning somewhere in the region of 3%. So you can actually get a return on your money from that. And of course the stock market predicting what's going to happen in the future, probably some 8 or 9 months hence, and clearly telling us that we're going to be entering a recession of some sort if we're not there already. And I think in parts of Europe, clearly they are in recession because of the magnified energy crisis there, partly caused by the Ukraine issues. In the UK, GDP just keeping its head above water, but I think it's going to feel very recessionary in the UK as the weeks and months pass by as we go through Christmas and into next year. And certainly interest rates going higher, helping savers for the first time in a long time, but not helping the property market and not helping those people with mortgages, which have tripled in terms of rates over the past few very short weeks, from 2% now to, I read today, nearly 6% in the mortgage market in the UK. So property investors, let's talk about property a little bit, because real estate investment trusts, both in the US and in the UK, have fallen quite significantly this year in anticipation of a slowdown in those markets. Not just the commercial side of things, but the residential side of things. We're forecasting housing prices in the UK and probably the US as well to fall somewhere between 10 and 15% as we move into 2023. But we're not there yet. And I think that's the key to it. It doesn't feel all that recessionary right now, but I think by the time we get to the beginning of 2023, it's going to feel completely different. But of course, by that point, equity markets, ironically, may well have picked up, because they're going to be looking beyond that cycle, and they're going to be looking beyond what's going to happen in the first quarter of 2023. And at that point, I think things are going to look a lot more interesting. So what is the message to investors today? Is it to sell everything? Is it to buy more? Is it just to hold tight? What would you be saying to your clients looking at their portfolios today?
Well, Russell, I think we mentioned this a few times over the last few days. The one thing you don't want to do is give good quality capital away to other investors. And if you're invested in good quality holdings, companies that have strong balance sheets, collective investments that focus on companies with strong balance sheets and, low leverage, little exposure to the derivatives market, progressive dividend yields, these are things that we've focused on for a long time. And quite honestly, I don't have a problem sleeping at night. I am invested in these things, as you are as well. We both have skin in the game. And, I said to somebody this morning, I've got my husband's money invested in this market, so I would be in danger of divorce if I invested in anything less than the safest long-term assets. But ultimately, yes, you can get 5% on a retail deposit now if you fix it out for a year, which is great for people who don't want to take the equity risk. But if you consider that inflation in the UK may well remain at elevated levels for some time, it could be 4% that inflation settles at in the UK, you're only going to get a 1% real yield then in your 1-year fixed deposit potentially. And you have to make that money potentially last, 15, 20 years. So you need some growth in your portfolio, but you also need some income as well, because you want to be able to reinvest that into these falling markets. What I'd say to people right now, I probably wouldn't want to catch a falling knife. I think we are in a period of still very difficult markets. I think if you've got new money, don't be in any hurry to invest it too quickly. I'd certainly take advantage of any severe dislocations like we've seen the quasi-quartering effect. I think that's a temporary phenomenon that will right itself as possible buying opportunity, maybe for short-dated gilts, maybe short end of the US Treasury curve as well. Not so sure about the long end of the UK curve because, I don't know in terms of the fiscal strength of the UK how they're going to work this budget. We'll find out more at the end of October. But certainly invest where you think, you've had a serious dislocation. I think that's the right time. It might seem counterintuitive, but otherwise don't be in any too much rush to pile in everything now. Certainly wouldn't be selling.
No, absolutely. It's a really wise words, Mary. And of course, what's really interesting this time around is that 2008 was a banking crisis. This definitely isn't a banking crisis, at least not yet. The banks are far better capitalised than they were back in 2008. It's not a technology crisis like it was in 2001. It's more of an economic crisis and much more of a macro feel to the crisis. But at the root cause, time and time again, of any crisis is too much debt and too little liquidity. And the one thing we spend a lot of time on is looking at the companies that we invest into and making sure that they haven't taken on too much debt in the good times when interest rates were rock bottom. Because if companies were struggling to borrow and struggling to thrive when interest rates were at 1%, when interest rates are 3, 4, even 5%, they're going to face real difficulties. And so picking the survivors and making sure you can work your way through the storm by not becoming a forced seller and holding and adding to your holdings wherever possible, I think is the key to long-term prosperity and happiness. Mary, thank you very much indeed.
Russell.